Hey guys, Victor here with Individual Investor. As a new investor, probably one of the first books you read on investing was The Intelligent Investor by Benjamin Graham. Chapter 14, called Stock Selection for the Defensive Investor, outlines specific criteria that you can follow to pick your own stocks. So what I want to do here is to show you how you can use the stock screening tool on Morningstar.com to find some stocks that pass some of these defensive investor criteria that Graham outlines in the book. If you're not familiar with Morningstar, I'm going to show you real quick how you can use their screening tool. So if I click on Research, Stocks, and then we scroll down to Tools, and here you can get to the Premium Stock Screener. Obviously, you have to have a premium subscription with Morningstar. However, they do offer free trials, I think for 14 days or for a full month. So you can test it out yourself. And if you like it, you can commit to the subscription if you want to. So here, if you see here in the top left, select data to screen on. So here you can click on the drop-down menu and you will find some criteria that you can use for your screen. Okay, you have some performance figures here, some financial ratios, and also some of Morningstar's own filters as well, like the fair value, uncertainty, or the Morningstar rating. Now, I would recommend that you click on actually view all data, because this will take you to the full list of data points that you can use for your screen. As you can see here, the list is a lot longer than what's available in the drop-down menu. So here, just to show you a quick example, let me click on here, dividend yield percent. So I can click on that, and here you have the condition, greater than or equal, and then you select your value. So this could be a number, or you can screen against another ticker, or for example, a dividend yield percent greater than, whatever stock you select. So I'm going to select a value here, and then I'm going to select 5, type 5 here, okay. And here you'll see now that we have over 1,000 matches, or 1,000 stocks that pass this initial criteria, a dividend yield of 5% or more. Something cool that Morningstar allows is screening against other values as well. So what I mean by that is, if we go, for example, to the earnings per share of year 1, or that's the most recent year, you see that I can select either a numerical condition, so let's say greater than $1 in this case, or I can select to screen against another value from maybe a previous year. So if I select a year 2, in this case, this will mean that I want to pick stocks where the earnings per share in the last year was greater than or equal than the year before. Okay, so I'm going to click on OK here, and here now we have our 2 criteria, and you see that we have around 428 stocks that pass this screen. So these are 428 stocks that have a dividend yield of 5% or more, and earnings per share of the last year greater than or equal than the year before, or year 2. Okay, so following this logic is what we will use to start building our screening filters for the defensive investor criteria. All right, let's now recap the 7 criteria for stock selection for the defensive investor, and then we will see how we can apply some of the Morningstar filters to find stocks that pass those tests. Number 1, adequate size of enterprise. The book recommends that we stick with companies with a market cap of at least $2 billion. Number 2, strong financial condition. For liquidity, the book recommends a current ratio of 2 or more. And with regards to solvency, Graham likes companies with a working capital that is greater than the long-term debt. Number 3, earnings stability. some earnings of the common stock in each of the past 10 years. Basically, here Graham recommends finding companies with a positive EPS in each of the past 10 years. Number 4, dividend record. We want companies that have paid a dividend for 20 years or more. Number 5, earnings growth. We want companies with a 7% average annual increase or 100% growth in 10 years. Here you have to calculate this using the first and last 3 years EPS average. Number 6, moderate price to earnings ratio. Graham recommends only stocks with a PE ratio of 15 or less, and you have to calculate it using the last 3 years average EPS. And number 7, moderate ratio of price to assets. Graham recommends a price to book ratio of 1.5 or less, or a combination or a product of PE times PB of 22.5 or less, as long as the PE ratio is 15 or less. Okay, so for the first 2 points, adequate size of enterprise and strong financial condition, you can see here on the right hand side, inside the red box, the filters that I am using for the first 2 points. So first off, I have the domestic filter there. So basically I'm only screening for domestic companies. So basically companies that trade on American exchanges. Then I have the market cap filter, greater than or equal to $2,000 million or $2 billion. For the current ratio, you can simply apply current ratio of the latest quarter, greater than or equal to 2. And lastly, unfortunately, working capital is not a filter or a data point on Morningstar that we can screen against. So in this case, what I did was comparing the current assets of the latest quarter with the long-term liabilities, and only filtering companies with current assets greater than or equal to the long-term liabilities. Obviously, this is not quite the same because working capital actually equals to current assets minus current liabilities, but at least this filter will help us get rid of some companies that have a long-term debt higher than the current assets, which will obviously mean that the long-term debt will be higher than the working capital. Number 3, earnings stability. So we want some earnings of the common stock in each of the past 10 years. So basically what this means is that we don't want negative earnings at all in each of the past 10 years. I probably should have done here greater than 0 instead of greater or equal than 0, but at least we're getting rid of all companies that have negative earnings in the last 10 years. So this one is pretty straightforward. Okay, number 4 here, dividend record. Unfortunately, Morningstar doesn't let you go back or go beyond 5 years for dividend data using the screening tool. So in this case, I could only select the last 5 years, and I selected basically a dividend record in dollars for each of the last 5 years greater than 0. Okay, so that will get us at least, that will help us get rid of companies that haven't had a dividend in the last 5 years. And lastly here, earnings growth. Again, Morningstar, there is no way to go back and 10 years and calculate the average annual increase using the screening tool, or comparing the first and last 3 years of earnings. At least if you select companies that have a most recent EPS greater than 10 years ago, then there's a good chance that those companies have had or have experienced an earnings growth above 100% in the last 10 years. And lastly, 6 and 7 here, moderate price to earnings ratio and moderate ratio of price to assets, is something that you're going to have to calculate yourself. As you can see, this is not perfect. In fact, there isn't a stock screening tool that will give you an exact match for all the Ben Graham's criteria or stock selection criteria. However, this is good enough so that you can at least do an initial sweep of all the stocks out there and then have a list of stocks that pass most of the tests for the defensive investor, and then you can use your own research and due diligence to select the ones that you want. Let's go back to Morningstar and apply the screening criteria. So here we have it, and as you can see, 79 stocks pass this screen. So let's run this right now. And here we have all we have the list of stocks. You can customize the view here. So I have a predefined view called the Graham view, where I only look at the stock name, market cap, sector, industry, and price to fair value. Now, the price to fair value, this is something interesting that Morningstar offers. Basically, the fair value is how they evaluate stocks, and if you have a price to fair value of below 1, or a price to fair value ratio of less than 1, that means that the stock is undervalued according to Morningstar. And here they also have the fair value uncertainty, so they tell you how certain or uncertain they are with the valuation that they did for those stocks. Now, something to be careful of is, I don't know if you can see here the little Q next to the price to fair value. So that Q means that actually that price to fair value ratio was not calculated by a real analyst, but it was calculated by Morningstar's automated statistical analysis. Okay, so that was done by an algorithm, not by a real analyst. So obviously take all these fair values with a grain of salt and make sure you're doing your own due diligence, checking out all the financial ratios, reading the reports, etc., making sure that you're happy with the numbers. If you go through this exercise and start analyzing each of the stocks that passes this screen, one of the challenges that you will encounter is that a lot of these companies are not trading at low price multiples. In fact, in today's market, it is very challenging to find good quality businesses that are trading at PE ratios of 15 or less, or a price to book ratios of 1.5 or less. However, some of these principles for the defensive investor are timeless and still relevant. You can use the majority of the criteria to screen for stocks with a strong financial condition and a solid track record, so that you can start building a watch list and monitoring a lot of these companies. And when the market conditions are right and when the price becomes more reasonable, you can start to build a position in some of those stocks. And that's all I've got. If you like this video, please give me a thumbs up and subscribe to my channel for weekly videos. Any questions, comments, or topic suggestions, please leave them in the section below. Thanks for watching, and I'll see you soon.